Okay, this one's going to be good. This is my favorite breakout setup when thinking about creating asymmetric risk to reward trading opportunities, which is just a fancy way of saying risk a little to try and make a lot. It is a play on the pocket pivot Voodoo setup that you can read about in Trade Like an O'Neill Disciple by Gil Morales and Chris Catcher. Now, how I trade it is different to how they talk about it in the book. So I'm splitting this video into two parts. The first part is going to be teaching you about the Voodoo setup and their rules from the book. The second part is actually how I go about in my own trading executing it. So very, very specific in terms of where am I looking for the stock to set up in terms of a pocket pivot, the trigger bar concept, which I'm going to be taking you through. So where am I looking to enter? Where am I looking to place initial stop loss? How am I looking to free roll the trade? So the risk mitigation element, and then how am I looking to optimize the profits with the sell rules? There's a bit of overlap in terms of the sell rules. So we're going to be discussing that. And then at the end of the video, I'm going to show you how to screen for these type of Voodoo setups. If you are interested in a discounted MarketSmith trial, there is a link down in the comments below somewhere. They're today's video sponsor. You'll see a couple of their charts as we go throughout this presentation, certainly when we're talking about the big stock concept. So with all of that being said, let's get into the first half of the video. So a pocket pivot. You will probably be familiar with classic chart patterns, which are basically variations of flags, triangles, pennants, volatility contraction patterns, cup with handles, wedges, which could also be thought about as a VCP low mid pivot, and your flat base Darvis boxes. Within those, you can identify pocket pivots, Voodoo setups, or trigger bars, as I call them as well. So it's basically where you're not buying at the traditional breakout point. You are buying lower in the base. It means for me, if you identify it correctly, I think you can take really asymmetric risk versus reward trades. And then if the stock pushes up and then bases again, potentially creates another setup and or a classic kind of pivot point, you can then be pyramiding in and adding to the position and raising the stop loss on the initial entry. It all sounds a little bit fancy, doesn't it? We'll get into that in the second half of this video, but these are the type of areas where you are more commonly, as I pointed to with the arrows, more commonly going to see, as I punch the microphone, more commonly going to see these kind of pocket pivots, Voodoo setups form. So let's just give you an overview. So identify, what is the whole point of this? Well, it's to identify low risk tight areas where volume has dried up in the context of stocks basing and or in powerful uptrends resting briefly on their 10-day moving averages. Control. The point is creating asymmetric risk to reward trades, i.e. risk a little to make a lot. And then in the second half, we're going to talk about mitigate. It's not spoken about in the book. This is my kind of addition to it. This is how I like to trade. So I'm going to be showing you that in the second half of this video. If you don't want to learn about me and how I do it, just watch the first half. Pretty simple, isn't it? So mitigate. How to free roll positions to be risk free. Got lots and lots and lots of examples to show you. Optimize. Sell rules for riding trends using key moving averages. I'm going to show you my sell rules and I'll teach you about the sell rules from the book as well. There's a little bit of overlap between them. So let's just give you an identify summary of Voodoo pocket pivots. And Voodoo is basically an acronym for volume dry up. During the rally before the base, the stock respected its 50-day moving average or 10-day moving average. I would also add the 21-day EMA to that as well, because quite commonly you can see these setups forming around there. So it's good if the stock respects that moving averages. Now this is important because this helps from a trade management standpoint, which will be discussed later, and helps to understand the stock's character, which may sound a little bit esoteric and woo-woo, but understanding how the stock moved previously is a good indication for how it may move in the future, which we're going to come on to that later on. On the pocket pivot entry day, volume is equal to or greater than the largest down volume day over the prior 10 days. If the volume has a habit of being choppy, varying greatly from day to day, then increase to 11 to 15 days. There should not be a lot of big spiking down volume bars in the chart over the prior 10 days, as well as the stock's overall base formation. Ideally, the volume should be relatively consistent over the prior 10 days, preferably drying up, and then should burst higher on the day of the pocket pivot. Ideally, the stock is a big stock. What does that mean? Meaning it's an O'Neill can slim type leader. I'm going to show you a couple of the charts of what I think are some kind of O'Neill can slim type leaders in the market at the moment in time. Additional points, the Voodoo candle, I call these trigger bars, is sitting on at least one key moving average and not extended from its 10-day EMA. In the book, they use the 10-day simple moving average. I use the EMA on my chart. I just prefer it. So when you see it, see the charts, you're going to see the 10 EMA. Minimum base duration is ideally 2 to 3 weeks. Initial stop loss less than the stock's 20-day average daily range percentage, ADR. This helps me when I'm planning out the trades, keep the risk in check, and it's a good metric. So as I said, in the second half of this video, you're basically going to learn about how I go about implementing this. So if you're not interested in that, don't watch the second half of the video, just watch the first half. Quite simple, isn't it? Here we go. So there's a whole raft of quotes. I've got maybe about 5 slides on quotes. I don't want this to be an English lesson where I'm just reading to you. I think you're probably going to be more interested in getting into some charts, right? So you can pause the video, you can read these quotes. These are quotes from the book if you want to read it. So here you go. You can pause the video on these specific pages and read about it, but I'm just going to be teaching you about it when we get into the charts. Optimize, this is quite a good one. Find 1 or 2 big winners and you'll put yourself in the position of making big money in any bull market if you handle them correctly. So they were not just flipping out trades because they were up 10%, 12%, 15%. Nope, they were trying to sit and ride big intermediate term trend follows. In essence, Gil Morales and Chris Catcher, how they're talking in the book, certainly on the long side, were much more intermediate term trend followers. That is my interpretation of it. They were not kind of short-term traders. They're trying to get positioned and then sit for big trends to play out. As Livermore said, the big money is in the sitting tight. So let's start getting into it. So these are going to be some pocket pivots from the books. And what's a little bit irritating, if I'm honest with you, about the book is in terms of the entries, it's not very specific. And I don't like when there's vagueness, subjectivity, and there's just an arrow saying pocket pivot breakout. Like, okay, but where am I looking to enter it? Where's my initial stop loss? Like that, and that's what I want to do in the second half of this video. Like go ridiculously deep on it. Like really, really, really deep on it. Like you shouldn't have any questions by the end of this video. If I've done a good job in this video, like it should just be like that. You should just see it, know it. Where are you looking for these to set up? Where's the initial entry point? Where's the initial stop loss? Check that relative to the ADR. How are you then thinking about free rolling the risk? What are then the sell rules to optimize the profits? Like take all the Vegas, all of the subjectivity out of it and just get like into it. Okay, so these are just some ones here. You can see this is, you could think about this as a little kind of like VCP and a low pivot coming on, 1021 and 50 SMA. So on the charts that you're going to see, let's just go over this now. Black line, 10-day EMA. Blue line, 21-day EMA. Purple line, 50-day simple moving average SMA. Grey line is the 100-day SMA, and the red line down here is the 200-day SMA. They're going to be consistent upon all the charts that you see. So the 3 most important moving averages to be paying attention to is the black line, 10-day EMA, blue line, 21-day EMA, purple line, 50-day simple moving average. Nice, okay? So I'm just going to show you some of these ones that come up here, and you'll see these are the ones from the book, and you'll notice that none of them look quite the same. And it's like, well, where are you looking to buy it? Where are you placing your initial stop loss? And it irritates me somewhat. I think it's a really good book, but I don't like it when there's questions that are unanswered. And for like you as the reader, you probably want to know, well, specifically, where am I looking to buy this? Like, where am I placing my initial stop loss? Like, be specific. Tell me. I want to know. Like, that's why I'm reading the book, right? So that's what I'm going to try and do in this video and give you, like, how I then think about it. Charles Schwab here. You see how this is, it looks very different, right? You can see the volume coming through. Yes, it's then higher than the prior 10 days. It's larger than the highest volume bar on the prior 10 days in terms of a down day. And the volume bar, even though that one there is spiking up, it's actually up on the day. But you see what I mean? Like, it's not overly clear. Apple, this is a really good one. You're going to see some setups like this. So I actually think here, this is one of the best ones from the book. Why? Because of the tightness and price element to it. So you see how price just starts pretty much building these higher lows and going into a tight range. So tight ranges are really important, and clustering around, or when you get the 1021 and the 50 SMA doing this on a larger base, so potentially that base is getting to like 8, 12, 16 weeks, something like that on the shorter basis, it's going to be the black line and the blue line, 10-day and 21 EMAs, which are going to be really important. But these are what pocket pivots look like. Basically tightening ranges, volume dries up, pops up through. But again, not very clear from the book, is it? Well, where are you looking to buy it? Where does your initial stop loss go? How wide should your initial stop loss go? Should it be 7, 8%? Could it be tighter than that? How can you then free-roll the trade and then try and sit for a big trend? Nice. We're going to go get into sell rules. Don't worry. Here's another one, VeriSign, from the book in here. Okay, it kind of bounces off the 21-day EMA. Okay, where do you kind of place your initial stop loss? This one here, ISRG, you'll see a couple of them that they talk about in the book, like buying the day before earnings. So here is a pocket pivot, the volume pops up there, but again, buying the day before earnings, you can read the quote here about why they buy before the earnings. I think that's a little bit cowboy YOLO action. For me, I wouldn't be doing that. Certainly if I haven't free-rolled the trade and got a kind of decent profit cushion on it as well. Baidu, I think this is a relatively good setup here. It's somewhat of a double bottom pattern. So here's the left side, here's the right side, then it pops up. Look at the tightness coming through. So this is going to be a key thing to start taking out, especially when we get into the second half, okay? Is tightness as the pivot is developing. Now, the tightness as the pivot develops is often going to look like a mini Darvis box, where price may drift sideways for 3, 5, 7 sessions, something like that. Maybe a little bit more, maybe a little bit less, depends on the setup. But the tightness in price and relative to at least the black line, which is the 10-day EMA, and the volume drying up significantly is very important. Now, some of you eagle-eye viewers may have noticed there's this line down here and there's some blue dots coming up. What does that mean? That there, it's a free tool. Search my name on TradingView and the indicators, you'll find it is the relative strength line. So even better for me and how I think about it is if you can identify a stock building a pocket pivot, a Voodoo setup, puts in a trigger bar, which you're going to learn about a little bit later on. Trigger bars for me are really, really, really important because that's where I'm then setting the perimeters for where I'm looking to get in, where I'm placing the initial stop loss, and then doing free roll targets off of that. But if you can see 52-week highs coming through and 52-week highs while the stock is still basing, that's telling you something. It's telling you the stock is very, very, very strong indeed. Here's another one, Nvidia. See how it looks pretty different in terms of setup. It's kind of a cup and handle type pattern. It pops up here on the earnings like that. But again, where are you looking to buy it? Where are you looking to place your initial stop loss? Like, how wide is the initial stop loss? Like, the whole point for me of like these pocket pivots where they get really, really tight is like really control the risk. Like really control the risk. Like tight as you're going to learn as we go into the second half. Here pops up and then starts trending, but see the trend that comes from it. So you're going to start learning about the sell rules a little bit later on. So it's all about taking minimal risk, capture a lot of upside. This one here, so you can have bottom fishing pocket pivots as well. You can go and read about this, but bottom fishing pocket pivots as well. Let me give you some examples from the book. So you can see here the stock starts building a base, actually comes down, puts in, undercuts the low down here, then starts building a basing action. Basically the stock stops going down, try and say that 10 times quickly, and then starts putting in these high lows and reclaiming the 50-day moving average. You want it to be reclaiming the 50-day moving average at a minimum, but ideally has gotten back above the 50-day moving average, because you're going to see some faulty examples of pocket pivots as well. But on these entries here, well, where's your entry? How are you doing it? Are you doing it during the session? Are you doing it at the session? It doesn't say in the book on Voodoo setups. It's irritating, right? So are you doing it at the end? Then where do you place your initial stop loss? That. But then the point is try and get position and then ride trends. ISRG, so see how the stock basically stops going down, starts tightening up, and then it reclaims the 50-day moving average here. There's a little pop-up in volume. But again, are you buying it opening range highs? Where do you place your stop loss? Are you buying it at the end of the session? That doesn't say in the book on the Voodoo setups. Baidu here. So it starts reclaiming. This is a couple of days before the earnings. See how it starts basically rounding out here. Starts rounding out. Look at the tightness and price. Look how the volume dries out. Again, I don't, from my own experience, for how I then trade these kind of setup, I don't think it's a very good example. Maybe I'm poo-pooing a little bit, but it is what it is. I'm going to give you my honest answer. You can get 10-day moving average continuation pocket pivots as well. So these, the base durations won't be as long. They'll be much shorter bases. Potentially they kind of pull down, set into their 10-day moving averages. They get really tight. You're going to learn all about trigger bars, specific things to be looking at when you then go on an intraday time frame as well. So you're looking at, say, the 1 hour chart, breaking that kind of quote-unquote trigger bar down when the volume is really dried up. So here's some here. So Apple, this is a 10-day moving average continuation pocket pivot. Again, it's a day before earnings. Yes, it's a pretty good bar. Yes, it then meets their kind of pocket pivot criteria, but day before earnings, I don't know about that one. This one's better. See how this tightens up, like really nice tight price action, and then look at all the 52-week highs. So Apple at this moment in time is a big stock, is a TML, true market leader, really liquid. Look at the relative strength coming through, huge earnings, huge sales, beat in terms of the estimate as well here. That's why it's popping up green, and then look how it just tightens up here. A little flag, Darvis box there, really tight. These are better ones. Here it gets really tight as well in here. You can learn all about that. First Solar. These are then 10-day, so continuation pocket pivots off the 10-day moving average. There's one in here, there's one in here, there's one in here from the book. This would be my favorite one over here. Stock builds out a big base, little shake out demand tail. So again, I'm going to be teaching you about where's the entry, where's the initial stop, how to free roll it, how to then sit for a move like this, like really specific. Let's just do a couple of faulty pocket pivots. So things you want to avoid: V-shape, wedging up, extended from the 10-day moving average, and in a downtrend. Let's go through some examples from the book. This one here is a good entry. Like, this is solid here, really tight around the 10-21, like that, really tight bar. So you can go in again, create asymmetric reversal trade through the higher of the bar, stop loss underneath the lower of the bar, free roll into it at a multiple of the risk, and then sit for the trend. But the first one here is incorrect. I'm getting ahead of myself. The first one here is incorrect. Do you see how it has like this V-shaped look to it? Okay, V-shape, where it then runs really quickly up. From a supply and demand perspective, if you think about it, there's still trap buys within the base. So there's people that are potentially buying the dip and then going, I'm just going to sell it or sell part of the position as it pops into the overhead resistance. And then you have overhead supply from people who bought it higher up. They've sat through the loss, they get back to break even, they hit the sell button so they can remove the pain that they are currently feeling from having a losing trade. So V-shaped ones do not allow the overhead supply really enough time to have been absorbed. So that's why you want kind of tight sideways action, potentially a couple of shakeouts in the base, but where it just then starts building high lows, getting nice and tight. Don't worry, we'll do all of it. Do not worry. Wedging up. A little bit more of a subtle one to be training your eyes to, because here you can see, this is how they refer to it in the book. See here? This is like wedging up. So it's actually building like little kind of higher lows into it. It's, yeah, kind of wedging up here. But then maybe this one here is also wedging up. Like you could just draw a trend line there and connect the lows. Like, I don't know. Wedging up is very, very, very subjective. That's all I'm going to say on it. Some work, some don't, is what it is. But this here, this is not wedging up. So this is actually better, okay? You see how it's not wedging up, it's actually pulling down here, and you have a break of this downwards trend line. You have a nice shakeout demand tail here, you start tightening up here. So this here is really good. Like this is not wedging up. Like this is good. Also, great reaction to the earnings coming through. But extended, the point on this one is extended from the 10-day moving average. So the black line on my charts is the 10-day EMA. I use the EMA rather than the SMA. You use whatever you want, but I don't change my moving averages when I do these videos. I like to keep them as I do it, because then that's how I see the charts. I know what I'm looking for. But you see here, incorrect here. So you see how, yes, it is a pocket pivot. You have the volume drop. It's a large volume in the last 10 days, so on and so forth. But you see how there is distance between the low of the bar and the 10-day moving average. So ideally, and you're going to learn a little bit later, in terms of when I'm planning the trade out and when I'm looking for these type of setups, I like to get the initial stop loss underneath the 10-day EMA. So it just helps me avoid buying stocks that are extended if I can get the initial stop tight and under the ADR percentage over the last 20 days, and it's underneath. So it's initial stop loss less than the ADR percentage over the last 20 days, and the initial stop loss is underneath the 10-day moving average at a minimum. That's what I'm looking for. Don't worry, you're going to learn about all of it. So this here would be incorrect. Can you see the distance here? I'm just pointing to it with the cursor. See that there? And again, where would you be looking to buy it? Up here? And then stop loss down there? Don't know. Up here as well. Incorrect, okay? It's coming out here, but you see this is wedging up. So number one, it's extended from the 10-day moving average, and see how the stock has just run up here. Like this is really wedging up. It's like 45 degrees, right? That's really wedging up. Like that's a no-no. Even though the stock's hitting 52-week highs, wedging up extended from 10-day moving averages, no. First Solar, another one. So this is very strong stock, great reaction to the earnings, but this is more like pocket pivot type action for me, how I kind of trade it and think about it, right? Like down here, around the key moving averages, when the stock is pulled back down, so it's lower on in the base. Up here, it's extended. You can see the distance between the stock, the lower the bar, and the 10-day moving average. Same here as well, and it's kind of like wedging up here, like no, this one here as well. See how it's wedging up? It's like 45. This is really wedging up, 45-degree angle. Yes, it's hitting 52-week highs. Yes, the volume is high relative to the prior 10 days, and the volume dried up kind of okay. But again, you don't want to be buying up here, okay? So don't worry, second half of this video, like that, really deep. Extended from the 10-day moving average is improper. So this is another one. This here is a much better setup. See how it builds? You could look at this. Those of you who are Minervini aficionados may call this a VCP, where you have 1 contraction, 2 contraction, nice shakeout of demand tail, and then 3 over here where it just gets really tight. Look how the volume dries up, and then there the volume pops through. But you see the really tight bar that comes through. This is what you're going to be learning later on in the video, second half, where I start going into trigger bars and then controlling the risk. But up here, this is extended. Okay, the stock is trending nicely. The RS line is strong. Yes, the volume kind of meets the pocket pivot criteria, but it's extended from the 10-day moving average. That is a no-no. It's also wedging up like this. That is a no-no. Takes a little while to train your eyes, but when we go through the second half and you start seeing lots of I think perfect examples, start clicking like that. Stock in a downtrend is improper. So yes, you have the volume popping up on these days. Yes, it is then higher volume relative to the prior 10 days. Yes, it kind of meets the rules, but it's context here. Stock is in a downtrend. Remember, the red line is the 200-day simple moving average. See how it's in a downtrend. Purple line is the 50-day moving average. See how it's in a downtrend. So you don't want to buy pocket pivots in the context of downtrends. Yes, as we looked at earlier, you can have the bottom fishing pocket pivots, but that is when the stock is basically basing, starts making higher lows, and is at a minimum above its 50-day moving average. In this instance here, for all 3 of them, you are fighting the trend of the market. You're fighting it. Don't fight the trend. The trend is your friend. This is the big stock concept. Now you can pause the video, you could read all this, or you could just watch the next slide where I just summarize it for you. So here you go. What is the big stock concept? This is basically O'Neill and his TMLs, his true market leaders. So in essence, a true market leader has a global product and or huge addressable market. Big earnings, big sales, big estimates, liquidity, impressive relative strength, and bonus if there is an excellent story behind it. You don't need to overthink it. Like that there is basically the big stock concept, TML type stocks. Sometimes you don't have the big earnings coming through, but you'll have huge sales coming through, and it's the expectation of future big earnings because of the big sales that's really driving the share price higher. Sometimes we try and make these causal links because that's then driving that. Sometimes that is the answer. Sometimes it isn't the answer. But in terms of a big stock concept, they're basically the key points to memorize. So let me show you some of them in the market that I think are there right now. Nvidia is a big stock. You think about AI as well, the revolutionary new technology. So even though Nvidia at the minute, yes, it has earnings coming through, but earnings are actually down on a year-over-year basis and sales are actually down on a year-over-year basis, but it's trading what seems to be, again, maybe I'm just trying to make a link there and it's not actually trading on that. I think it may be trading on that, and obviously it's at kind of the forefront of AI in certain respects as well. But if you take a look at the estimates, 2024, going from earning 77 cents to $1.23, $1.66, $1.45, $2.44, $4.44, $3.34, $7.09, $9.99. Like think about the size of this company. It's over $1 trillion stock, and the estimates for next year are 112%. Think about that. Think about that. That's mega massive. Earnings share growth rate 28%, comp rating 99, return on equity 34%, solid. Bigger boys playing around in it. Look at the RS line pointing to the sky like that. It's in all-time high territory. Ridiculously liquid as well. That's another thing that large operators look for. Liquidity, perceived value, two things they require above everything else in my view. Celsius, I think this is a TML type stock. Now this one actually has some good estimates coming through, but it's also the sales growth and the earnings coming through as well. So as I was saying there, like global product and or huge addressable market, you want some high quality funds playing in there, you want some decent liquidity for the institutions to be playing around with, taking positions. And then take a look at the sales here. 8 quarters ago, $65 million for the quarterly earnings coming through. In the most recently reported quarter, look at the sequential growth going through here, 259 million. That's huge growth sequentially, quarter over quarter and year over year. That's really good. Then if you take a look at the earnings per share, the most recently reported number was up 344% year over year, and it was 40 cents. Look at 40 cents versus the other reported EPS, like 1 cent minus 13 cents, 15 cents, 9 cents, 12 cents, losing $2.46. 40 cents, massive, really interesting. Stock, all-time high territory, really strong RS, good estimates, okay? Big stock idea. Relatively new in terms of its IPO, huge earnings coming through, sequential growth in the sales, good estimates coming through, pretty liquid, good story behind it as well. Like it. If you think about some of the other stocks historically, in terms of like apparel stocks and shoe stocks, you think about Nike, you think about Crocs. Don't know why Crocs did so well. A lot of people bought their shoes. I think their shoes are pretty terrible. Personally, I quite like Ons. I'm currently wearing a pair of Ons. My wife likes them as well. We go running in them. But anyway, Skechers as well. So again, think about the area. If you think about going back to Celsius as well, Celsius is a non-alcoholic beverage related company. You think about some other non-alcoholic beverage related companies in the past 40 years. Ones that come to mind would be Coca-Cola, would also be Monster Beverage as well. In the early noughties, had huge runs, so the market can have a bit of a love affair with stocks in this industry group. That's pretty good. The stock also, its character, which we'll kind of come on to later, is it can run really hard from nice big bases. That's good, isn't it? Planeter, I think it's probably one of the leading software AI related stocks. Big earnings coming through, triple digits the last 2 quarters at the time of filming, sequential growth in the sales as well. Solid estimates this year, 252% with the guidance up. Very, very liquid stock, breaking out of this phase 1 base, now in a nice phase 2 option. Relatively new in terms of an IPO. So hopefully that gives you an idea of the big stock concept. So let's go into Optimize. So these are the sell rules from the book, and then I got a couple of charts to explain them to you, and then we'll do my sell rules a little bit later on. So the key moving averages from the book, 10-day simple moving average and the 50-day simple moving average. So there are 2 rules I'm going to be teaching you about here from the book. The 7-week rule, which is if the stock holds above the 10-day SMA for 7 weeks after entry, sell on the first violation of the 10-day simple moving average. A violation is defined as a close below the 10-day moving average, followed by a move on the next day below the intraday low of the first day. And you might be like, what? Don't worry, got a chart, a couple slides time, then I'll explain that. Then there's the 50-day moving average rule. If the 7-week rule has not been met, then it is better to use the 50-day simple moving average as a selling guide once violated. So if the stock closes below its 10-day moving average within the first 7 weeks, use the 50-day to sell the position instead of the 10-day. Hopefully that makes sense. If you want to read about it, you can read about it. Let me just show you a chart. So here would be the entry. This is a pretty good pocket pivot. You see how it builds a little base in here, gets really, really tight on this day. Look how the volume dries up. Look at the 52-week highs. Look at the volume coming through as the stock started to base out of here or break out of here. Really, really, really good. So this here is a good setup, and I'll be teaching you about how I think about where the entry is, where the initial stop is, how to free roll it, how to ride the trend. But in terms of the sell rules that you will learn in the book, this meets the 7-week rule. Why? Because the stock for the first 7 weeks does not close below the 10-day simple moving average. And on my chart here, I've got the 10-day EMA. I just like using the EMA. I think it's a little bit quicker. I prefer the EMAs rather than the SMAs on the 10 and the 21. That's just me. Maybe you disagree. Maybe you use something else. I don't really care. But you see here how it bounces multiple times. Bounce, 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 bounce. Doesn't close below, just bounces off of it. That's good. Look at all the 52-week highs. But once it's violated, the 10-day, here, see how it closes below the black line? What they're then saying in the book is basically either watch it intraday and as soon as it moves below, sell it, and or just place your stop loss at the low of that bar, probably by a couple of cents or so. So that there would then be the exit here on this day here. So it's not here on the close below, it's here. That's what they use as a sell rule. Then another one, here you can see some other ones. So entry number 1, this is the pocket pivot here, kind of tightens up here. There's the pocket pivot entry. These are from the book. So here would be the first entry. Now on this bar here, it closes below the 10-day moving average before 7 weeks. Okay, so the 7-week hold rule does not kick in. And the 7-week hold rule is really there to try and keep you in some of the market's biggest winners because they will generally respect their 10-day. I've also found, I've done my own stats, I'm going to show you a little bit later on, the 21-day EMA as well. So what they would then say is sell on a close below the 50-day moving average. And it's, again, you could sell on a close below the 50-day moving average. It's not overly clear in the book, but you could sell on a close below. But if you're doing the violated rule, then your stop loss will be placed underneath the low of the 50-day moving average. So in this instance here, you may then be kept on, but then you're taking like a lot of risk and there's potentially a big change of character. Damn, it's a little bit vague, a little bit subjective, isn't it? This one over here, there's another pocket pivot. This is much better. Starts clustering, gets really tight. Look how the volume dries up in here. Around about 2-3 weeks worth of trading. Really, really tight volume, 10, 21 and 50 SMA. Do that. You get a nice big shakeout to Montel here. Then it starts tightening, pops up through. So that there, in my book, is a really, really good entry. Now it closes below the 10-day moving average here before 7 weeks. So what happens? The 50-day simple moving average rule kicks in, and then the exits would be here, this kind of vicinity in here, because even though it starts closing below over here, you're waiting for a close below the 50-day moving average. Make sense? I don't think it's that complicated, is it? So basically, let's just go back a chart. So if the stock doesn't close below its 10-day moving average following a pocket pivot breakout or potentially a higher base breakout as well, the sell rule would be hold on to it. If and when it then, well, eventually it is going to close below its 10-day EMA, isn't it? So once it does then close below, then basically place a stop loss at the low of that bar and then you get stopped out on the next session, or potentially it bounces and continues going higher. Not that complicated. If it closes below its 10-day moving average before 7 weeks, use the 50-day simple moving average. It ain't rocket science, is it? Nice. So now I'm just going to give you a couple of my own stats here. So I actually like to use the 10 EMA and I like to use the 21 EMA as well. It's better suited to my personality. Sometimes I may keep some back for the 50. Again, depends on the character of the stock. So this is me. I looked at 500 different trades, put a couple of statistics together. So I was eyeballing where would the initial stop loss be on these 500 trades, around about 4.95%. That's where, before I even started this, I would expect it's probably going to come in around about 5%. Because I think if you're swing trading around these kind of breakouts, pocket pivots, VCPs, cup and handles, Darvis boxes, flags, pennants, whatever you want to call it, right? I think if you're eyeballing it, you're swing trading off the daily chart, your average stop loss, I think is probably going to be somewhere between 3% and 5%. If you're looking for really tight bars, then it's going to come down a little bit. But if you took kind of an average of everything over that, around about 5% came in where I'd expect it. Average close, when the stock closed below its 10-day EMA on a percentage basis was 28.82%. Average close on a close below the 21 EMA percentage was 42%. So you can actually see the 21 EMA statistically is better to be using than 10-day EMA. However, for my personality, I like to use both. So I use both. Make sense? Here we go. Let's go on to the next slide. So we're now going to go into the second half, which is I'm going to teach you how I go about using, you could call it the Voodoo setup, whatever setup you want to call it. This is my preferred entry method for breakouts and to try and get involved in leading stocks. So I'm going to be going ridiculously thorough, ridiculously deep, very specific, and teach you exactly how I think about it. So there's going to be, hopefully, by the end of this video, no vagueness, no subjectivity. Like, you should really just see it. I don't think it's rocket science. I'm not very smart, so I have to kind of dumb it down, make it nice and easy for myself, make it very repeatable for myself, and I know specifically things that I'm looking for and then how to plan out the trade as well. So we're going to do a section which I just call putting it all together. Doesn't that have a nice ring to it? So let's start off here with Sky West. What chart pattern do you see? Cup and handle, right? Here's the cup, here's the handle. Now, some key things to be paying attention to is the relative strength. Relative strength should be pointing up like this. Even better if you get 52-week highs coming through. Good reactions to earnings are always good in my view, hence why it's called a good reaction to the earnings. Why? Gives you a sense of what are the big boys up to, what are the large operators doing. If you see bars like this, widespread, I call this bullish synchronicity. There is a synchronicity between what price did and the high volume coming through. So i.e. you want to see bars that are wide, open near the low, close near the high, volume confirming the move. Nice. Then afterwards, multiple tight candlesticks as the stock is basing. So you see these tight candlesticks. Generally speaking, they're tight candlesticks. Volume could be above average, average, below average. If volume is average or above average and you're seeing these tight bars come through, I think of that as absorption of supply. When it's then low volume, which I want to see in the pivot and the trigger bars then coming through, don't worry, you're going to learn about trigger bars, is this. Tight candlesticks and the volume dries up. Now, the way I then target it, through the high of said trigger bar, which is a really tight bar sitting on the 10-day EMA, volume is below the 30-bar average, okay, then for me, I don't know whether volume is going to be coming through high or not that session. It just is what it is. Because for me to then control the risk, I'm targeting it through the high of the trigger bar, stop loss lower the trigger bar, and I don't know. Like, maybe mega volume comes through, maybe it doesn't come through. I don't know. Such is the nature of the beast, but I'm trying to take the risk out and then try and ride the intermediate term trend. Now we'll come on to some sell rules a little bit later, but to give you a heads up, I'm using the 10-day EMA, which is the black line for part of the position, and I'm using the 21 EMA, which is the light blue line here, for the other part of the position. However, if I think price starts getting extended from the 10-day EMA, I might go lower the day, lower the day, lower the day, or lower the bar, lower the bar, lower the bar, subject to the time frame, to choke off some or all of the position. Depends how I feel. I'm a human being. If I think the stock could be like a mega leader and it's broken out and the 50 SMA was close by in the vicinity, I may keep part of the position back for a close below the 50, or I may not. It depends, right? So it's important, I think, to have kind of a toolbox, understand the character of the stock as well. How was the stock move previously on said breakouts? What were the optimal sell rules? Because a stock has a character. So go back, look at previous breakouts the stock has had. What was the optimal way to manage it? Was it when the stock started getting extended, choke it off, lower the day, lower the day, lower the day, lower the day, choke it off, get rid of all like that? Or was it actually this stock rides its 50 SMA like perfectly? 50 SMA is going to be the one. Or maybe it's a combination of the 10 and 21. Look back. Not every stock moves the same. So I don't think every stock should be treated the same. Depends how it's moved. Apply a little bit of common sense, right? Here we go. Skyworks. This is on the 1 hour chart, giving you an overview. But let's get into it, okay? So here we go. Remember that trigger bar that I was just blabbering on about? This here, trigger bar. Nice tight bar. The volume dries up, so it's here, okay? The bar, whatever we want to call it, the volume bar before the black bars. That's the volume bar there. So this is the trigger bar, okay? Now there's a couple of things I want to point out. So this is then hopefully going to start taking all the vagueness, all the subjectivity out. I like using multiple timeframes. I think multiple timeframes give me an advantage, so I use them. So we're going to go look at this bar here, and we're going to do it on the 1 hour chart. Okay, so this is just an overview. There's your cup and handle. Okay, here. This here is breaking down that trigger bar onto the 1 hour bar, the 1 hour time frame. So there's going to be 7 bars. Okay, there's 6.5 hours in a trading session, so you get 7 bars. One of them is a half an hour bar. Don't get caught in the weeds. 7 bars that we're looking at. So when you see the trigger bar, there's a couple of things to look at, and I'm not going to spend a great deal of time on it here. I think reps and sets, if I just keep kind of pointing out a little thing here and there on different examples, and there's lots of examples to go through, it may start clicking. When you look at a trigger bar, firstly, look at the volume. Ideally, there's not much volume coming through in the session. Sometimes you can get a pop-up in volume on certain candlesticks, on certain bars, but it's the interrelatedness of price and the volume. Well, okay, volume popped up, but what did price do? Was it a shakeout demand tail? Was it a gap down reversal bar? Don't worry, you may not know what they are, but you will by the end of this video. What you're in essence looking for, though, is potential shakeout demand tail. So you see this bar here? It has a tail. Okay, the tail, being the shakeout demand tail, undercuts the last 4 sessions or so. What's that doing? Shaking out the weak hands. Get rid of those stops. Okay, stop loss hunt, tree shake, some people call it, whatever you want to call it. But this bar here, see how it undercuts the lows of the last 4 sessions. And what do you notice about the volume? What do you notice about the volume on that bar, which again is a shakeout demand tail? So the intention of that bar is to shake out weak hands. What do you notice about the volume? There ain't much volume. is below the 30 bar average, which is this black line. What does that tell you about supply? How many stops were hit? Not that many. Is that good in terms of thinking about it? It's potentially a cup and handle, looks really strong, great reaction to the earnings, tightening up here, stock sitting on the 10-day. We're seeing a shakeout demand tail intraday that undercut the last 4 or 5 session lows, and there was very little volume. What's that telling you? Very much supply. And then remember what I blabbered on about earlier, multiple tight candlesticks on low relative volume tells you what about supply? There ain't much supply. So on that quote-unquote trigger bar, what have you just seen? Shakeout demand tail, undercuts recent lows, hardly any volume, tightness for the rest of the session. Isn't that interesting? So then let's go in terms of how do you actually set up the trade? Now, I'm not talking to you, I'm just telling you what I do. Here's how I think about it. So the trigger bar, I use buy stop limit orders in the vast majority of cases. Not always, but in the vast majority of cases, I will use a buy stop limit order. Now, this is why the trigger bar concept for me, so here's the trigger bar, this is why the trigger bar concept for me is very, very, very important, because I'm trying to create asymmetric risk versus reward trades and take the risk out really, really, really quickly, which you're going to learn about. So here is how I'm setting it up. I'm looking to buy, so the buy stop is the trigger price, which is going to be the high of said trigger bar day, which in this instance here is 28.70. Then I attach a limit to the buy stop. So it is a buy stop limit order with a stop loss attached. So the limit in this instance here is going to be 0.5% above the high of the trigger bar. Now that may vary depending on the stock, but invariably it is 0.5% to 1%. It depends on the risk, depends on the stock, depends on how the market is acting as well. If it's a tougher market environment, I'm tightening everything up, not widening it. If it's a bit of a better market environment, maybe I'll widen it up a little bit. But it's important to me to attach the limit on the buy stop limit order, because then I know the maximum risk that I'm going to have. So remember, there's 4 parts, I think, to every trade. Identify, control, mitigate, optimize. Following along? So knowing my maximum risk I'm going to have is really important for me to, number 1, know the maximum risk I'm going to have, and number 2, free roll the trade. Risk mitigation. So here, in this instance, I'm not willing to pay any more than $28.84 for any shares. Then my stop loss is going 1 cent below the low of the trigger bar day, which in this instance here is $28.06. So if I get filled at the upper end of my limit, my buy stop limit order, I'm not going to pay any more than $28.84. So my maximum risk on the trade is going to be here. 2.7%, which is 78 cents worth of risk. Make sense? So this blue shading here is indicating the zone where I'm going to get filled. So how I'm planning this out, my stop is going to be somewhere between 2.26% and 2.7%. That's really helpful, because now I can think about mitigating the risk. Let's go through risk mitigation, and we're going to do a little bit of maths as well, so try and stay with me here. So let me just give you an overview here. So imagine I'm using a buy stop limit order here. This is how we were setting it up. We're going to assume that I got filled at the highest point available. Okay, 28.84. I get filled here. Okay, initial stop loss here, 2.7%, which is 78 cents worth of risk per trade. Let me take you through some maths. So if my entry is at 28.84 for 3,000 shares, my total invested is $86,520. My stop loss is at 28.06 on 3,000 shares, which is $2,340 worth of risk. Why? Because it is 78 cents times 3,000 shares. Hopefully you're still with me. 1/3 of the position, so I'm going to sell 1/3 of the position at 2 times my initial stop loss. So I'm going to sell 1,000 shares, because 1,000 is 1/3 of 3,000. Hopefully you're with me. 1,000 shares sold at $30.40. Locks in $1,560 worth of profit. So remember, I'm selling at 2 times the initial stop loss. So I've just sold 1,000 shares at $1.56 gain, which is up here on the chart, right? 30.40 up here. This is in the free roll level. Now, what does that mean? Why on earth would I do that? So if my stop loss is still at 28.06 on the remaining 2,000 shares, I have how much risk? $1,560. Didn't we just hear that figure a minute ago? We did, didn't we? Why? Because it's 78 cents times 2,000 shares. So I've just locked in by selling 1/3 of the position, $1,500 profit, and my risk on the trade is $1,500 because I've still got 2,000 shares with a stop loss down here, which means if I get stopped out on the remaining 2,000 shares at 28.06, I free rolled. I'm break even on the trade. Get it? That's why trigger bars are important. That's why defining your risk is important. I'm trying to get in, free roll it, sit for the intermediate term trend. Not too difficult. RCL, big cup and handle type pattern, okay? Cup and handle type pattern, tight inside trigger bar here. Look how the volume dries up. Look at the 52-week highs. Here builds a little VCP, whatever you want to call it, okay? And here tightens, 10-day EMA, tight inside bar sitting there. Ready? Let's go through the trade. This is what it looked like on the 1 hour chart. Note the tightness. when you go down to the 1 hour chart and you start looking at it, 10, 21 and 50 SMA like that, the black, blue and the pink line nice and close together, I think is quite constructive, quite good. So here you go. Here we could be thinking about it. Okay, stop loss. Stop loss underneath the low of the bar. Okay, buy a cent, 78.04. Targeting it through the high of the bar, 79.18. I want to get filled, let's say within 50 cents. So this time here would be 0.64%. So 79.68. So the maximum risk that I want to have on the trade if I get filled up here would be 2.07%, which is $1.65. Let's then work it out here. So filling in here, okay, imagine it gets filled here at 79.68, pulls down for a session, don't get stopped out, then it reverses up here. So then 2 times the initial stop loss would be up here. So $1.65 risk, then selling up here at $3.30 is then 2 times, okay? So if the entry is here at 79.68 for 3,000 shares, total invested $239,000 pretty much, total invested. Stop loss at 78.04 on 3,000 shares is $4,950 worth of risk. Why? Because it's $1.65 times the 3,000 shares, because remember our stop loss is down here on the whole position. Then that's our 1/3 of the position at 2 times the initial stop. So that's 1,000 shares at 82.98, which is $3,300 profit locked in. Why? Because we're selling 1,000 shares up here at $3.30 gain. Stop loss still stays at 78.0804 on the remaining 2,000 shares, so we have $3,300 worth of risk. Why? Because it's $1.65, so the stop loss is still down here, times by the 2,000 shares. So we've got $3,300 locked in. Our remaining risk is $3,300. So if we get stopped out on the remaining 2 shares, so i.e. it U-turns and comes back down, which I'm going to show you 3 examples of, relatively recent as well. If it U-turns and we get stopped out down here at 78.04, we'll break even on the trade. Nice. I call that free rolling. So the intention is get in, free roll it, ride the trend. 10 EMA, 21 EMA, potentially the 50 SMA, potentially choke it off if it starts getting extended. But take the risk out really, really, really quickly. Let me show you another one, Unity. So this one here puts in this trigger bar type action here, shake out demand tail underneath the 21, volume dries up. Let's go through the example, and I'm going to bring ADR percentage into this now as well. So here, this is the 1 hour session broken down. So there's 7 bars here. See this big shakeout demand tail for the first 1 hour candlestick. Shakeout demand tail, shakeout demand tail, shakeout demand tail. Then volume dries up, little rally there, and it's in the context. This is happening, importantly, underneath the 21-day EMA, where a lot of people put their stop losses. So if you see a shakeout demand tail underneath the 21 EMA and the stock's been trended up, it's quite good to see. Get those weekends out, shake them out. Leading stocks are trying to go higher with the fewest amount of people on board. Really key concept. So let's now bring the ADR percentage into it. So this is, you search on TradingView, you can find it. I use this one here. If you type in ADR percentage, then a space, then /, I think it's by Armour Schlucker or something like that. I use that one, does the job perfectly. It's just maths. It's not overly complicated to calculate it. But this here, so the ADR percentage, the average daily percentage move on the daily chart, excluding gaps over the last 20 days, is 5.71%. So ideally, I want the initial stop loss to be half of that. But if it's around it, okay, thinking about it. But ideally, like half to 2/3 is a good metric to be thinking about. The rationale behind, if the initial setup, and this is then the trigger bar concept, if the trigger bar and targeting it through the high, even going like 0.5% above and then initial stop loss is then like half the ADR percentage, it is reasonable to expect the stock could move how far it's moved on a percentage basis over the last 20 days, correct? So therefore, if you're selling 1/3 at then 2 times the stop loss and the stock can go its ADR percentage and your initial stop is half the ADR percentage, you can free roll it day 1. Nice. Now we're getting somewhere. So in this instance here, 40-20, for the buy stop price, then the limit 40-40 like that. So max risk on the trade would be down here at 4.38%, which would be $1.77 worth of risk. So there, entry there, makes sense. So there, let's then run through this one so you really start getting the risk mitigation element. So entry at 40-40 for 3,000 shares, that's $121,000 invested. Stop loss at 38.68 on 3,000 shares means there's $5,310 worth of risk. Why? It's $1.77, so the $1.77 times by 3,000, we're getting there. So 1/3 of the position at 2 times the initial stop loss. So 1,000 shares sold at 43.94 equals $3,540 profit locked in. Why? Because we just sold in here. We sold 1,000 shares at $3.54 profit. Makes sense? Which is 2 times the $1.77. So 2 times is the magical number if you're doing 1/3. Now, I don't want to confuse you and go crazy in this video, but you could free roll by moving the stop loss from low the trigger bar to low the breakout day. Then you can bring down that percentage that you're looking for and free roll quicker. Nice, take the risk out. Stop loss at 78.07 on remaining 2,000 shares equals $3,540 worth of risk. Why? Because we have $1.77 and we have 2,000 shares left. So 3,500 minus 3,500 equals $0. if we get stopped down here at 38.63 on the remaining 2,000 shares. Position Freerolled. Here's TTD, another software related stock. So see how it tightens. Shakeout demand tail underneath the 21-day EMA. Nice shakeout. Take a look at this on the 1 hour chart and note the relationship of where the 1 hour chart is in relation to the daily 21 EMA. Tight, there's breakout. So here we go. Decent base building here as well. So that's an overview on the 1 hour chart, but let's go into the specifics. So this session here, this is the pain of the weak hands who place their stop losses underneath the 21 EMA. There they are. That's them there. They're being shaken out right there. And then the stock reverses without them. Nice. And then the trigger bar, look at the tightness in price. Even intra-session, intraday, you get this shakeout demand tail. And what do you notice about the volume? Very much volume. Remember what I was teaching you about SK, what it was? It was SKYW. That shakeout demand tail and not much volume. So big shakeout demand tail, not much volume, tells you what about supply? Very much supply, which is what you want to see on a trigger bar, right? Tightness, low volume is what you want to see, because then you can really control the risk. So imagine here, targeting it through the high of the trigger bar, stop loss sent below, so 76.23, and then the limit on the buy stop here, 0.5%, so 76.61. Max risk on the trade would be 2.13%, which would be $1.63 worth of risk. And the ADR percentage is 2.45%. Okay, would be ideal if it was tighter. It's okay, it's still pretty tight around like 2.25%, but ideally it's even tighter. Like, that's what you really want. Ideally, like, really tight. So TTD hit, right? Flies out, and then obviously then free rolling it. You can go and read the maths over here. I think I've probably done that enough. So $3.26 is 2 times the $1.63. So here, within the first 2 hours, position free rolled. So in, still got 2/3 of the position, free roll it. Now try and ride the trend. That's what you want to try and do. RXST. So here's an instance here where you get this tight trigger bar action, right? You see this here? See how it tightens up, pulls into the 21 EMA. There's hopefully no vagueness, no subjectivity here. Tight stocks, tightness in terms of stocks that are base and constructive, showing relative strength, and then you get these really tight bars sitting on one or more key moving averages. 10 EMA, 21 EMA is going to be most common. Look how the volume dries up. This is trigger bar action. Really helps control the risk. Through the high, stop loss underneath the low, which is preferably under at least the 10 EMA. At least the 10 EMA, and then the initial stop loss is preferably half the ADR percentage. So 2.5 relative to 5. Okay, that's looking quite nice. Now, it wasn't quite that at this moment in time, because then when I wind it back and I do the bar replay, the actual ADR percentage was 3.46%. But again, if you plan the trade out here, here's what it looks like. So there, like that, there, 52 cents worth of risk. Let me then play it forward. So 52 cents worth of risk. So $1.04 would then be the free roll target for 1/3 of the position. So in, free rolled it. And then it's then about sitting. So within the first couple of days, this day here, second day, you've been able to free roll it, and then it's about trying to sit, and then you get another trigger bar that forms here. Look how the volume dries up. Look how it goes again. You could pyramid and concentrate into the position there, but let's not do that in this video, otherwise we'll be going too far into the weeds, I fear. OPRA. Okay, so it puts in this trigger bar. See how it opens on the low of the bar, closes on the high of the bar, initial risk through the high, underneath the low, be around about 3.74%. And then look at the trend that unfolds. Maybe you hold here, maybe you don't hold here. It does close below the 21, but maybe you can hold down, maybe you don't. Maybe go stop loss of the day because it's kind of a green bar and it's a little gap down reversal bar. Don't worry, you'll learn about gap down reversal bars a little bit later on. But look at the 52-week highs coming through already. Here's another like trigger bar type action over here. Stock pulls into the 1021 after a positive reaction to said earnings report. So here, this is good to see. See the tightness in price. Look at the tightness in price coming through, and look at the relationship on the 1 hour chart of the black, the blue, and the purple line. They are like that. You cannot get a paperclip between them. It's really, really, really good. So let's just then work through this one. So targeting it through the high there, 11.23, initial stop loss sent below, $10.81, limit, maybe we go 1% here, okay? Percent, because it's a lower price stock, a little bit of liquid, so maybe it's 1% here. So 11.35 would be the maximum I would be willing to pay for any shares in this hypothetical example here. And then down there, that would be 54 cents worth of risk, minus 4.8%, relative to the ADR, which at this time was 7.14%. It's okay. What's that? Around about 2/3 or so. So here, within the first 2 hours, position is free rolled. See how tight the prior action is here on this trigger bar day. Look at the last 3 bars and look at the tightness coming through. It's really, really, really good. So let's just work through this one. Entry 11.35 for 3,000 shares. Total invested about 34k. Stop loss at 10.41 on 3,000 shares. So the risk on the trade is $1,600. Why? 54 cents times 3,000 shares. 1/3 of the position at 2 times initial stop loss is 1,000 shares sold at $12.43. Right here at $1.08 times the 1,000. So $1,080 locked in. Stop loss at 81 At 1081 on the remaining 2,000 shares is $1,080. Why? Because it's 54 cents worth of risk. Remember, the entry was here, bought them here at 11.35, and then the initial stop loss on this example here would be down here at 1081, so 54 cents. So we've got 54 cents times 2,000 is $1,080. Makes sense? So we've got our profit locked in of $1,000 minus the risk remaining of $1,000 equals $0 if we get stopped. Makes sense? It's nice and easy. It's not too complicated. This bar here, really nice. Inside bar, following the shakeout demand tail. Look how the volume dries up. This is the trigger bar concept. Hopefully it's making a little bit of sense. See the tightness that comes through? Look at the tightness. I'm going to do this a little bit later on, like tightness, 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 tightness. Tightness. That's what you want to see. Let me show you some U-turn ones. So this is why Freerolled then stopped. I was in all of these. These next 3 examples I'm going to show you. So this is why risk mitigation is really, really, really important. So here's 3 that I was in. AEHR. So entry here, Freerolled here, and then I get stopped here, break even on trade. So let me run through it and show you. So look at the tightness that's coming through, price in relation to the 1021.50 SMA. Nice. Look how the volume dries up. Nice and tight, right? So here, 0.5%. So looking to get filled somewhere between 40.79 and 40.99. Initial stop loss sent below 39.49. So max risk on the trade be $1.49 or 3.64%. Make sense? So here, see how the stock gets out, hits the target. Now I actually pushed up the stop loss and Freerolled it earlier because I keep open the kind of, in terms of strategy, lower the trigger bar day to potentially lower the breakout day region and then take off a third and or half, depends on the market environment for how quick I want to try and Freeroll it. But you can see in this instance here, you can pause the video, you can go through all the maths over here, right? But gets out and then it U-turns back here. So rather than get knocked out with a full stop, I get knocked out break even. Make sense? Makes sense? Z-scaler, here's another one. So I bought this one here, coming through this day, and then 2 days later, it's done a full U-turn like this. So again, it's tight initial stop of around about 1.9% relative to the ADR, pretty darn favorable, but it does a big U-turn. So this is why that third part of the trade, remember, I think there are 4 parts to every trade. You won't read about this in another book. This is just me, this is how I trade, this is my own experience. I haven't written a book, I just do YouTube videos. I like doing YouTube videos. Kind of find it like therapy, like talking to myself, right? But here, so there's identify, there's control, there's mitigate, and there's optimize. The risk mitigation is so important in my view. I hate getting stopped out. Like, it's losing. Hate losing, right? What's worse about having a losing trade, and again, it happens, right? Show me a happy loser and I'll show you a loser. Like, I don't like losing. Like, I don't like it. But what's even worse than getting knocked out is when you have a profit on the trade of 5, 6, 7, 8, 9%, and then you get knocked out with a full stop. Isn't that irritating? So here's Z-scaler. Right, here you go. So you can go and read about different stats and stuff like this for how you could be thinking about the trade, where the entry is, the amounts and all of that stuff. But here, you see how it moves through here? Look at the tightness that comes through. Look at the tightness. One key thing here, look at this bar here, by the way. Okay, look at this bar here. And then note where it is, this bar here. See the shakeout demand tail underneath the 21, and look how it undercuts the base lows. Think about all the stops that just got triggered in that vicinity there, and then the stock tightens up there afterwards. So see, this is the pain of the weak hands. This is the weak hands being stopped, see you later. And then it tightens up, shakeout demand tail, starts recovering, and then you get tightness coming through. It's really good to see. But here, right, the stock gets out pretty well. What does it go up? Maybe 7% to the high there, and then there's a whole 180. There's a whole U-turn. This is why the risk mitigation is really important. Shockwave Medical. So I had this one here, and it finished the day with a big supply shoot, and then I got knocked out on this day here. It's really irritating when a stock gets out really well, and then it just rolls back over. But it's trading. You can't avoid it. Anyone that tells you you can avoid whipsaws, you can't. I mean, if you can, and you find a strategy that has 100% kind of perfect winning accuracy, let me know. I'd be very interested in it. But you cannot, in my view, avoid whipsaws. It is part of trading. Part of the game. It's irritating, yes, but what's more irritating than getting knocked out with a full stop is getting knocked out with a full stop when he could have free rolled the trade. Like, that irritates me. So that's why I use risk mitigation and these free rolling tactics I'm trying to talk to you about in this video. So here's Shockwave Medical. Here's how you could be planning the trade out like that. So here's the entry like this, gets out really well, and then it just rolls back over. But again, free rolling into it is really important. So now I just want to do a couple of things. We're getting into kind of the final part of the second part. Then I'm going to show you some of the screening as well, to how you can go about finding these in what I think is probably the quickest way possible. Like, it's ridiculously quick. I'll show you how quickly you can do it, but we'll do that in the final part of this video. So what I just want to emphasize here is the trigger bar concept. I really just want to drill it in to you. Like here, trigger bars. tight, tight, tight. If you haven't watched the recent Jesse Livermore video, you'll recognize some of these charts from that video, but I want to focus on a specific thing here. So trigger bars, okay? On the daily chart, look for price to be pretty darn close to at least a 10-day EMA, which is the black line. And then ideally, if it's a bigger base, the 21 EMA is there as well, okay? But tight bars. Oftentimes they look like inside bars. Like inside bars, low relative volume is really important. There may even be a shakeout demand tail or a gap down reverse bar. Don't worry, you're going to learn about gap down reverse bars in a minute. Underneath a key moving averages. Maybe it's a 21, maybe it's the 10 EMA, maybe it's the 50 SMA if the 50 is there as well, okay? Look for that. Shakeouts in bases, and then tightening up afterwards. And when you then do the multiple time frame analysis, look for the pain of the weak hands being shaken out, and then where the stock then recovers. Right, leading stocks are trying to go higher. In my belief, is they are trying to go higher with the fewest amount of people on them. So gap down reverse bars, shakeout demand tails are quite common to see. So what I want you to just dial in is when you then see the trigger bar, okay, on the daily chart, and I'm just going on YouTube. I don't know anything. Don't listen to me. Go and research this yourself. But this is just what I see time and time again. So you would have heard me blabbering on the 1 hour chart about the black, the blue and the purple line, which is the 10 EMA, 21 EMA and the 50 SMA. Oftentimes when you see a really nice trigger bar on the daily chart, such as this bar here, when you go down to the 1 hour chart, you will see behavior that looks quite similar to this. Basically a mini Davis box, and the first 1 hour candlestick may be a gap down reversal bar, which you're going to learn in a couple slides time, or a shakeout demand tail, but then tightness. Price just consolidating on those 3 key moving averages, and volume is pretty low. Okay, so I just want to dial it in and show you example after example. WEAV, trigger bar coming through here. Okay, when you go down and then you look here, look at the 10, 21 and 50 SMA. This is a gap down reversal bar. So price gaps down, opens near the low, little shakeout demand tail, pushes up, and then tight, sitting on the 10, 21 and the 50 SMA. Not bad. That's what you want to see. This, tightness. BYSA, trigger bar in here, you're going to see this bar here and this bar here. Okay, look at the tightness. Look at the relationship of price to the 10, 21 and 50 SMA. Look at the shakeout demand tail. Look at the little gap down reversal bar. It's really good to see. This one here as well. Look, gap down reversal bar, prior closes here, gaps down, again, gap down reversal bars and shakeout demand tails, shakeout weak hands. It's really good to see. And then the tightness coming through. So it's tightness. Tightness, low volume tells you there ain't much supply coming to the market, which is really good before targeting a breakout. Look at the tightness coming through. Look at the shakeout demand tails as well. Shakeout demand tail, gap down reversal bar with a little shakeout demand tail. Low volume tells you what? There ain't much supply coming to the market. ALGM, more of a kind of classic handstand name. Cup and handle type pattern. Let me just jump it forward. Here you go. Gap down reversal bar, tightness in price on the 10, 21 and the 50 SMA. That's all happening there. Then try and ride the trend. AT80, Chinese related stock. Inside bar here, trigger bar, building higher lows. Look how the volume dries up. Go down. Here is bullish synchronicity bar, lots and lots of demand. Here, tight bars, average volume tells you absorption of supply. Here, gap down reversal bar, prior closes here, gaps down, open here, pushes up. Look at the 10, 21 and 50 SMA. They're like that. Look how the volume dries up. Makes sense? GOTU, this happens underneath the 200-day moving average. It's more in the long-term downtrend, but builds this flag type pattern. And then look at the tightness coming through. This is what I really want to emphasize. Look at the tightness. Gap down reversal bar and a shakeout demand tail here. Shakeout demand tail here. Look at the tightness. Look at the low volume. And that's before the stock goes up like this. And then up here, this would be lower the bar, lower the bar, lower the bar. Like, check it off. It's extended. It's gone a long way, okay? EXPI. So now I want to show you, like, the perfect chart pattern. And depending who you talk to, we'll call it different things. Some people will call it flag. Some people will call it power play. Some people will call it high type flag. Some people will call it a Davis box. Whatever. It basically looks like a staircase. Like, just looks like steps, okay? This is the best chart pattern you could possibly find, in my view. And I don't know what I'm talking about. I'm just some guy on YouTube. EXPI, okay? This here, this is the one here, okay? Stock that's in a powerful uptrend, and then it basically just goes horizontal like that, okay? And the moving averages just catch up, and it holds above the black line being the 10-day EMA and potentially the 21 as well. And remember what I was blabbering on about earlier about shakeout demand tails. Shakeout demand tail, shakeout demand tail. Then it's the tightness coming through. So these are then the trigger bars. And look here, as the stock is basing, remember what I said earlier on, pay attention to the relative strength. The stock is hitting 52-week highs on the relative strength line whilst it's still within the base. The stock is extremely strong. So this here, breakout, pull in, and basically just going sideways into the moving averages and tightening up into then over here, little rectangle, little Davis box, isn't it? And look how the volume dries up. This is where I love to look for pocket pivots, voodoos, whatever you want to call them, like that. Then same stock, ready? Remember what I said earlier about the behavior of the stock tends to repeat. Wow, doesn't that look? This is then a year later. This is 2016, this is 2017. Look how similar these chart patterns look. Like, it's the behavior, it's the character of the stock. Why do they do it? I don't know. They just do it. Study them. So see here, moves up, goes sideways. Like, see how it then finds supportive action on the black line, the 10, then the 21 catches up. Then look at the tightness that comes through here. Look at the ridiculously tight bars and how the volume dries up. These ridiculously tight bars mean what? It means create a really asymmetric risk versus reward trade. Like, really asymmetric. Okay, the whole point of trading, I think, is try and take minimal risk and capture lots of upside. Repeat. It ain't complicated. Here, powers up, pulls in, now you get the 21 catching up. And look at this shakeout demand tail, and then the tightness come through. Look how the volume dries up. And here, this is one where clearly up here, it's extended, isn't it? From the 10-day EMA. Guess what? As I was talking about earlier, lower the bar, 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 choke it off. All, some, part, depends. Here as well. See how it starts powering up here, then you get this big supply shoot. Lower the bar, lower the bar, lower the bar, lower the bar. Choke it off like that if you want to. Make sense? Celsius, same pattern. Goes up, pulls sideways, finds support action on the 21 EMA. This is a little gap down reversal bar, then it's tight, 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 tight. Look how tight it gets in here. Look how the volume dries up. See the tightness, see the volume dry up. Here, goes sideways, finds supportive action, generally speaking, on the 21 EMA. There's a couple of shakeout demand tails. Look at the tightness. And then it powers up. Makes sense. AMD. High tight flag, I believe, pretty much high tight flag. See how it moves up here, pulls down. This is a gap down reversal bar. Underneath what moving average? 21 EMA. Gaps down, pushes up, and then it tightens over here. Look how the volume dries up. And ride the trend. Tesla. Great reaction to the earnings. Remember what I said earlier, multiple tight candlesticks on high volume, average volume, or low volume tells you absorption of supply or limited supply coming to the market. That's how I interpret it. And then it pulls down to the 21 EMA. So remember I said earlier, 21 EMA, 10 EMA, really important to then be looking for these type of setups. For me, that's how I trade them. See how it gets really tight in here. So again, it's about creating the asymmetric reversal trade and then the trend rides. And remember what I said about going lower the bar, lower the bar, lower the bar. Like, this is pretty darn parabolic. Like, it's the highest volume ever traded at this point, I believe. Lower the bar, check some off. Not too difficult. Games Workshop, UK stock. Powers up, goes sideways. Look at the tightness into the 10 EMA. Look at the tightness. And then remember how I was explaining earlier in terms of thinking about the trade and setting it up. I was telling you how I do it. Higher the trigger bar, lower the trigger bar, 0.5 or maybe a %. Depends on the stock, depends on the market environment for the limit on the buy stop. Stop loss down there, take a third off, and then ride the trend. Here's another one. This is ETH. I'm going to show you ETH and Bitcoin. So it's not just stocks that move like this. It's cryptocurrencies. Why? It's just supply and demand. This setup here is ridiculous. See how it goes up here and then it starts basing, finds support around the 21. Little pop here. Tight, 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 tight. Basically going sideways. And the volume dries up at this point in time too. And then it's about trying to ride the trend. So I like using the black line and the blue line. 10 EMA, 21 EMA, they work quite well for my personality. Maybe keep some back for the 50, depends. If it's kind of like a nice Wyckoff phase 1 base and it's coming out of that and it's potentially early in the move and you think, this could go some way. Maybe it's going to trend higher for the next 9 months. Maybe it is, maybe it isn't. But that's why trading some with part of the position I think is quite effective. But apply some common sense. Where are you in the price cycle? Are you really late? Like, has the stock up here, like ETH here, this is like base 1, base 2, base 3, base 4, like base 5 here, like getting a little bit long in the tooth, isn't it? It's just gone from $8 to $420. Apply a little bit of common sense. Bitcoin here. See here how it just pulls in. This time you get the 10, 21 and the 50. So if it's setting up around the 50, I may be more minded to keep part of the position back for the 50 and sell on a close below there. But it depends on the context, right? Those of you who have played sport at a high level will know the best athletes, the best sports people adapt the quickest. Like Wimbledon's on at the minute. Like, those that are best adapt quickest. Like, it's about adaptation. It's about adapting to what happens. So just taking it one day at a time. You can have these wonderful ideas about how you're going to manage the position, but I think you have to react to, well, how is price moving? Has the stock just gone parabolic and has it just gone up 100% in 2 weeks? Okay, you may have been looking to hold some for, say, the 50, but now it's just gone parabolic. So what are you going to do? Do you know what I mean? Adapt. Have a toolbox. Have like a mental toolbox of how you're going to think through these things. Look at the tightness in here. See these tight candlesticks? Don't they just keep cropping up before a stock makes a big move? Or a cryptocurrency in this instance. Look at the tightness. Look at the tightness coming through. Look, it's really good. AB, this is a slightly different variation, but I wanted to show this because this is kind of the essence of a pocket pivot, right? See how it starts just building higher lows and it's much lower in the base, but it's setting up on the 10 and the 21, and look how the volume dries up. So tight bars. Remember what I said about tight bars and how I then think about entering the trade and targeting the trade through the tight bars. Here again, 50 SMA. See the tightness that comes through on the 50 and how the volume dries up. Again, tight bars, really trying to control the risk. Then I'm just going to show you some, just whiz through these ones, and then I'm going to show you the screening because I probably rambled at you for long enough. Look at the tightness that comes through. So on the next couple of charts, there's maybe 10 of them. Tightness in price, low volume. And note the relationship of the moving averages. So you'll get these like pocket pivot, these tight bars setting up across all time frames. I'm about to show you everything from like the 3-minute chart, the 1-minute chart to the monthly chart, and you just see it's just the same thing. It's literally supply and demand, and it's understanding for me where is best to target it. How I approach trading, I try and optimize everything. It's just how my brain works. Optimize, optimize, optimize. So look at the tightness coming through before the stock makes a big move. This is Berkshire Hathaway on the monthly chart. This here is a trigger bar. Hopefully now you know what trigger bars are. This here is a trigger bar sitting on the monthly 10 EMA. Trigger bar, low volume. Nice. Now, I wasn't trading Berkshire Hathaway here in 2006, but it's the same thing. I've studied history. I've studied stocks relentlessly. MBOT. See the tightness here? This is that trigger bar. Look how the volume dries up. Here it does it again. Builds this flag type pattern. There's a trigger bar coming through. Look how the volume dries up. Coca-Cola, weekly chart, trigger bar. Trigger bar, this is a really good example of it. Like this is textbook on the 10-week simple moving average, which is pretty closely aligned with the 50-day moving average. Look at the tightness inside week, sitting there, low volume. Relative strength, 52-week highs, it's a leader. Coca-Cola, cup and handle. There's a trigger bar. There's a trigger bar. This is AGLE, which is a biotech stock on the 1-minute chart in the pre-market. Same things are happening. Look at the trigger bars coming through. Look at price in relation to the moving averages. Again, black line, blue line, and purple line are the same irrespective of time frames. Unless it's the weekly chart where I use the 10-week simple moving average instead of the 10 EMA. But here, this is the 10 EMA on the 1-hour chart, 21 EMA on the 1-minute chart, sorry, 1-minute chart for both of those, and the 50 SMA on the 1-minute chart. Look how the volume dries up. Look at the trigger bars coming through. Exactly the same. BKKT, 1-hour chart, flag type pattern, VCP, whatever you want to call it. There's a trigger bar coming through. There's where the volume dries up. That's when the stock is ready to go, to my mind. Dow Jones. Big old VCP back in the 1920s, or 1 contraction, 2 contraction, 3 contraction, 4 contraction, and there you go. On the weekly chart, there's your tight little trigger bar coming through before it moves higher. It's timeless. PLTR, 3-minute chart, there's your trigger bar before it goes. VCIG, 5-minute chart, there's your trigger bar before it goes. HTCR, there's your trigger bar. Look how the volume dries up before it goes. Another one, 5-minute chart. There it is, little flag. There's where the volume dries up. There's the tightness, nice. WLDS, look at the tightness coming through on the 5-minute chart. So monthly chart, weekly chart, daily chart, 5-minute chart, hourly chart, 1-minute chart, same thing. I don't see anything different that happens. Little cup and handle, tightens up, nice. EVMB, there's the tightness coming through. Look how the volume dries up, tightness, volume dry up, so on and so forth. So what I'm now going to do is show you how to screen for these stocks in a ridiculously quick, efficient manner. So let's go. Okay, here we go. We are on my website. This is my platform, and I'm going to show you how to use my screener. At the time of filming this, there's a 7-day free trial available, and you don't even need to enter a credit card. So if you want to go and test it out, if you made it all the way to the end of this video and you're not a member and you want to try it out, see if it's worth the money, crack on. You don't even need to enter a credit card. So here we go. Go into stock screen here, and from the save screens, you can select let's do the VCP, the volatility contraction pattern screen. There's other ones. There's a high type flag screen. There's the uptrend screen, the can slim screen, the 52-week highs. You can create your own ones. We've got relative strength rankings and all of that good stuff as well. I'm just going to show you the VCP one. Okay. So here we go. I've clicked search on that, and now what I'm going to do is I'm going to filter it. I'm going to come to the table here, and we have different relative strength rankings. So we have relative strength 1 week, relative strength 3 month, relative strength 12 month, and then we have relative strength sector rank. So in the relative strength rankings, we're comparing the stock versus all the stocks in our database. In the relative strength sector rankings across these different timeframes, we are comparing the stock versus other stocks in the sector. So we've got sector relative strength rankings for the stock, and then we've got broad relative strength rankings. So what I'm going to do is I'm going to put the relative strength 3-month ranking to the top of the page like this. So I'm going to look at stocks in all of our database, which there's ebbs and flows. There's around about 5,500 stocks or so. I'm going to compare the relative strength for these stocks versus all the stocks in our database, but it's only the ones that meet my volatility contraction pattern screen. And you can see the criteria here. You can create your own screens and add all sorts of weird and wonderful things. If you want to, go and try it out. I would suggest it. So we have 316 results. Now what I'm going to do is I'm going to click charts. Now I've just got it on 1 per row, but if you want to make it potentially even quicker, you can put it 2 per row as well. If you want to click flex charts and get the earnings and the sales data, you can do that as well. So here we go. we've got some stocks that are popping up here. Nice. So AI, C3 AI related play, and this moving average that you see here, this is the 21 SMA. We can only have the SMA instead of the EMA on these charts at this moment in time. But you see here how it's pulling in, potentially building a big base, starting to go sideways, building high lows, and look how it's tightening on its 21 SMA in there. Isn't that interesting? That's starting to tighten up, and these are literally some of the top results. JOBY, look at this. Good move here on the volume, starting to tighten. Maybe needs a little bit more, 21 to catch up a little bit on that one. This one here is looking quite interesting. MOTX, see how it's starting to pull in here. It's tightening up after this big volume gap up. This was on the back of, I think, phase two trials meeting a primary endpoint, but starting to tighten. Look how the volume's drying up. Just really, really easy. And then you can just be flagging these. Let me go and find another one. IMGN. Look how tight this is getting around its 21. Like, this looks interesting, doesn't it? It bounced last time off of it as well. So what I could do is I could just go put that one in a preset watch list, or you can go and create your own watch list, put it in there, export it into Mark Smith TradingView TC2000, whatever you want to do. But it's a very, very, very quick way of looking for potentially some very strong stocks. BHVN, see how this is starting to tighten here. So I'm just dialing in, looking at the pattern recognition. IONQ, quantum computing, okay, potential Darvis box forming here. Maybe the 21 catches up a little bit, but that's looking quite strong. So I could just flag it or whack it into a watch list. Wolf, this is a crypto stock. Some of the crypto stocks looking really strong. PLTR, which I showed you the Market Smith fundamentals for that a little bit earlier on. Look how this is potentially building VCP, cup and handle type pattern, starting to tighten around the highs of the base. Maybe it just kind of pulls into $16. So I probably want to be flagging that one and keeping a close eye on that one. So I'll wrap it up there, guys. You can go and try that out for yourself. There'll be a link down in the comments below. So if you made it all the way to the end of this video, thank you very much. If you haven't subscribed to the channel, I'd really appreciate if you subscribe to the channel. Like the video, really helps me to grow the channel. Thank you very much for watching. I do really appreciate it. If you have any comments or questions, just let me know in the video below and I will happily respond to you when I get some time. Thank you very much, and I will see you in a future video.